is rebounding today, and this move is not random, emotional, or speculative noise. It is the direct result of shifting macro pressure, softer risk appetite, and a subtle but important turn in currency and rate expectations that traders across Europe and North America are now responding to. When markets grow uneasy, capital does not disappear, it rotates. And today, that rotation is flowing back towards silver as investors reassess risk, liquidity, and protection. The backdrop is familiar but increasingly relevant. Global growth expectations are cooling. Equity markets are more fragile than headline indices suggest, and geopolitical uncertainty remains unresolved rather than discounted. In that environment, silver reasserts its dual identity. It is not only an industrial input, but also a monetary metal that reacts when confidence in paper assets weakens. As risk sentiment softens, silver benefits from both sides of its personality, drawing interest from defensive allocators and tactical traders alike. A softer US dollar is adding fuel to this rebound. Because silver is priced in dollars, any broad weakening of the currency mechanically supports higher prices. But this is not just a mechanical effect. Dollar softness often reflects a deeper expectation that monetary policy is nearing a turning point. Markets are increasingly positioning for lower global interest rates over the coming quarters, and silver responds positively to that outlook. Lower yields reduce the opportunity cost of holding non-yielding assets, making silver more attractive relative to cash or short-duration bonds. In early European trade, silver advanced alongside other precious metals, confirming that this move is macro-driven rather than isolated. When silver and its peer metals rise together during European hours, it usually signals institutional participation rather than retail speculation. Swiss financial desks highlighted the same pattern: risk-off flows, a gentler dollar tone, and renewed interest in defensive positioning. These are not intraday anomalies. They are part of a broader recalibration taking place as markets digest slowing momentum elsewhere. Silver also continues to take directional cues from gold, even when the focus remains squarely on silver itself. Historically, when investors reassess monetary conditions or sovereign risk, gold often moves first, with silver following as confidence in the trend grows. Outlooks pointing to continued central bank accumulation of precious metals reinforce this environment. Even though silver is not directly purchased by central banks at the same scale, the sentiment spillover matters. When official institutions signal long-term mistrust in fiat stability, silver tends to benefit indirectly through increased investor demand across the metals complex. For Swiss investors, this rebound requires a more nuanced interpretation than simply watching the USD silver chart. The Swiss franc remains structurally strong, and currency effects can meaningfully alter local returns. A rising silver price in dollar terms does not automatically translate into the same gain when measured in CHF. If the dollar weakens faster than silver rises, franc-based returns may be muted. This is not a flaw in silver, but a reminder that currency exposure is a real component of performance. That is why product choice matters. Swiss investors must decide whether to accept USD exposure or use CHF-hedged instruments. Hedging can smooth returns but comes at a cost, often through higher fees or tracking differences. Over short horizons, currency moves can dominate metal price action. Over longer horizons, the metal's own trend usually reasserts itself. The right choice depends on time frame, risk tolerance, and portfolio role, not on headlines alone. Silver exposure in Switzerland can be accessed through exchange-traded products listed on SIX, through diversified funds with metals allocations, or via physical bars and coins sourced locally. Each route carries trade-offs. Exchange-traded products offer liquidity, tight spreads, and ease of sizing, making them suitable for tactical positioning. Physical silver offers direct ownership but introduces considerations such as VAT, storage, and liquidity. In Switzerland, VAT on silver can materially affect entry cost, which means physical ownership often makes more sense for longer holding periods rather than short-term trades. Cost awareness is critical. Bid-ask spreads, management fees, storage charges, and tax treatment can all erode returns if not accounted for upfront. A rebound in silver price today may look attractive on the chart, but real-world performance depends on execution. Sophisticated investors treat these frictions as part of the strategy, not as afterthoughts. In the near term, volatility is likely to remain elevated. Silver is sensitive to macro headlines, central bank communication, and currency shifts, especially when markets are undecided about growth and inflation trajectories. This means that while upside momentum may continue, sharp intraday swings are possible. Discipline matters more than conviction. Position sizing should reflect volatility, not enthusiasm. Preset stops and limit orders help prevent emotional decisions during fast markets. If silver approaches known resistance levels during this rebound, partial profit taking can be a rational tactic rather than a sign of doubt. Locking in gains on part of a position allows investors to stay engaged without overexposing capital. Conversely, if silver consolidates after the initial bounce, patience may be rewarded. Not every move requires immediate action. Often, the best decision is to wait for confirmation from volume, the dollar trend, or rate expectations. Silver also plays a role beyond short-term trades. As part of a broader portfolio, it can add diversification during periods when equities struggle and bonds offer limited protection. Its volatility is higher than gold's, but so is its responsiveness to reflation and recovery narratives. This makes silver particularly sensitive to changes in expectations rather than changes in data alone. Investors who understand this dynamic use silver tactically, increasing exposure when macro uncertainty rises and trimming when clarity returns. The current rebound reflects a convergence of classic drivers. Safety demand is returning as growth optimism fades. The dollar is losing momentum, easing pressure on dollar-priced assets. Rate cut expectations are lowering the cost of holding metals. Together, these forces create a supportive environment for silver, even if the path higher is not linear. Looking ahead, currency dynamics will remain central for Swiss investors. Monitoring USDCHF alongside silver is essential. A stable or weakening dollar combined with steady silver demand would support further gains. A sudden franc surge, however, could offset price advances. This is why reviewing positions regularly is not optional. Silver price today should always be evaluated against your base currency and your intended holding period. Strategy matters more than prediction. Rather than attempting to forecast every tick, successful silver investors define scenarios. If the dollar weakens further and yields drift lower, silver exposure can be maintained or selectively increased. If macro data surprises to the upside and rate expectations reverse, risk can be reduced. This approach turns uncertainty into a framework rather than a threat. Silver's rebound is also a reminder that markets move in cycles. Periods of neglect are followed by renewed interest, often triggered by macro shifts rather than asset-specific news. Investors who wait for perfect clarity usually enter late. Those who manage risk and act on evolving probabilities tend to perform better over time. As the session unfolds and new data emerges, silver will continue to react to the same core inputs: the dollar, yields, and risk sentiment. Central bank commentary, especially signals about policy flexibility, will remain influential. None of this requires constant trading. It requires awareness, preparation, and consistency. In practical terms, that means reviewing your silver exposure with a clear purpose. Is it a hedge, a trade, or a strategic allocation? Each role demands a different mindset. A hedge is not judged by short-term profit. A trade is not held out of loyalty. A strategic position is not abandoned because of daily noise. Confusing these roles is one of the most common mistakes investors make. Silver price today reflects a market that is re-engaging with defensive assets while remaining cautious. This balance can persist longer than expected. It can also shift quickly. The goal is not to predict the exact path, but but to remain aligned with the underlying drivers. For those considering new positions, clarity comes from preparation. Know your entry levels, your exit plan, and your tolerance for volatility. Understand how currency movements will affect your results. Choose products that match your horizon. And accept that no single trade defines success. Consistency does. In summary, silver's rebound is grounded in macro reality, not hype. Risk sentiment is softer, the dollar is weaker, and rate expectations are easing. These conditions support silver, even as volatility remains part of the landscape. For Swiss investors, currency effects, product selection, and cost awareness are decisive factors. In the days ahead, simple, disciplined tactics are likely to outperform reactive behavior. Track the drivers, respect the risks, and let the market do the rest.